Man, this cattle climate is definitely something that is of concern. It can be, there's opportunities, there's risk, but we'll look at what's happening and talk about some opportunities. Cattle prices have been extremely volatile, but that's not to be unexpected given everything else, how everything else has been. The problem with the cattle market is that we haven't seen this same increase in prices that every other commodity has seen over the past however many months. So cattle prices have not escalated like corn prices or soybean prices or your local steak prices or anything else or fuel prices. So they're going to remain volatile, but there is a lot of optimism in the market going forward. I really do believe that. We continue to have drought that's influencing heifer retention and cow slaughter rates and heifer slaughter rates. I think there's still some opportunities for margin operators out there. Need to look at some of that. And our international market, it continues to be strong. But there's a lot of things going on in the international market that's contributing to the volatility, and you never know how those things will play out. We just get right into slaughter cattle prices up front and see that for the most part, they've been steady this year. Very little bit of a seasonal pattern. These prices typically peak in April. We kind of had two different peaks for the first 6 months of the year, back in February and then back in towards late April, early May, but we never saw a true run up in prices like we would typically see as we head into the spring months and towards summer. But well ahead of a year ago, and these prices should soften somewhat going through the summer. But I do expect a strong fall market or strong fourth quarter market, really. So we'll see how that goes. We should beat $1.50 this fall, as we see fewer and fewer animals coming off of feed. But we'll have to let that play out and see how it turns out. 5 and 6 weight cattle on cue are starting to decline. The prices for those cattle are slowly declining. Prices again this week. I looked at the sales that have gone Monday and Tuesday. Those primarily being Dixon, Unionville, Knoxville, Pulaski, Huntington, and prices are definitely softer this week than they were last week. So these 5 to 6 weight calf prices are starting to decline, which is very typical for the summer, and they'll continue to decline more than likely into the fall. I don't think we're going to see that much of a decline going into the fall, because I think we're going to find out there's very, very few calves out there. And so there's going to be strong competition to put those on somebody's grass or in somebody's feedlot. So I'm not expecting some huge decline, but we will see the softness through the summer and into the fall. Yearling cattle have been just a total disappointment all year. These are weekly run auction cattle, but it doesn't matter if you're selling them in load lots or not. These cattle have just been a disappointment in price. We would expect these prices to begin increasing pretty soon. We have seen the CME feeder cattle index increase about $6 or $7, but then it started to falter again this week. With the run up in futures last week, it supported those prices. The cash prices actually started to increase, and now they've started to soften again with the uncertainty in the futures market. There's a lot to say there, and maybe I will here in a few minutes. Again, still the highlight of all this has been slaughter cow prices. We continue to move a lot of slaughter cows across the country. Those prices remain strong. That lean beef is needed. And I would just suggest, if you've got some, go ahead and get them moved before prices start to decline. When you can sell these animals for over $1,000, that's a pretty good salvage value on cows that don't need to be in the herd any longer. But don't expect these prices to continue increasing through the entirety of the summer, because they will succumb to the seasonal expectations of prices. The slaughter is the real storyline. It's part of the storyline that goes along with the drought. But we've got heifer slaughter up 2.4% and beef cow slaughter up 15.2%. And at the same time, you have steer slaughter that's down. So that's telling us that there's fewer animals out there because steer slaughter's down. There's only one way for a steer to go, and that's to slaughter. And when you have increase in heifer slaughter and increase in beef cow slaughter and steer slaughter's down, then we're continuing to contract a cattle herd, and we're going to have a smaller calf crop this year than last year. Next year, we're going to have a smaller calf crop than this year. So all those things are pointing towards higher cattle prices in the next several years. But right now, we have the western third of the country is still under severe drought conditions. Some, there's places that have found some relief with some rain, but a lot of them are in still rough condition, and they're moving animals. There's no way to retain these animals, and right now, it's hard to retain heifers right now, even in our location, given that calf prices haven't started to escalate. So people need that cash flow, so they continue to sell heifers, which leads to more animals and more heifers in the feedlot. And right now, I think this is setting us up for some really, really strong years in 2 or 3 years to come. But it's the question is if you can withstand it that long and tolerate it to see those good years. That's led to a lot of beef production. Beef production's up. A lot of that beef production is because of that cow slaughter. If it wasn't for the increased cow slaughter, that beef production would not have an increase. Pork production's down. I don't know if y'all heard, but they're closing a facility out in California. It's not a huge facility, but essentially it's right in the middle of Los Angeles. So shutting down a slaughter facility there, moving some animals out of Utah, moving them back this way. So we might see some changes in the pork industry moving forward. Broiler production continues to go up. I mean, it used to be that one of the big things for chicken was it was a lot cheaper than other meat items, and that's how the growth in that industry really took off, is because it was fairly inexpensive to buy chicken. But I don't think it matters what type of meat you go to the grocery store to buy right now. It's all expensive, and with high feed prices, the chicken folks and the pork folks are really going to struggle if we can have these sustained high feed prices moving forward, because they have to haul feed in. They can't put them on grass. They can't stretch out their production cycle very much. Those are very fixed type things for the most part, and we might see some changes in that if we continue to see high corn, high soybean meal prices. Things may change, and we may see reductions in production there. We just got the latest data for imports and exports for April. It's such a delayed set of information, but we continue to import a lot of lean grinding beef. Brazil continues to be a source of that. Australia continues to be a good source of that. And then, of course, we still import a lot from Mexico and Canada type things. But our exports have also remained strong. And so you can see here we exported about 308 million pounds in April, compared to importing less than 300 million pounds. We were around 290 or so. So we were a net exporter in April on beef. Some people like to see that. Some people get concerned when our exports when our imports are a lot higher than our exports, but our value of exports is always greater than our imports. So not a big concern in my eyes as we talk about that right there. Beef prices have been fairly steady throughout the year, kind of like the finished cattle market. Unfortunately, the packer still has considerable leverage over the cattle feeder. and that will come to a head at some point, especially when these number of animals get tight. I don't know if any of y'all saw where National Beef Packers has stopped construction of the expansion of their facility in Tama, Iowa. It's gotten so expensive to build that they've indefinitely suspended that expansion, because I think they started that expansion 6-8 months ago, something like that. And essentially, I guess it was going to about double capacity of that facility, and they put that completely on hold. Don't know if they'll start back, don't know when, if they will. And that's, it's just become too expensive to build it. I'm sure labor would also be an issue to some degree. So we'll see how that plays out. We'll see if these other facilities get built. But regardless of if new facilities come online or don't come online, when these cattle numbers get tight, there's going to be some competition for these cattle. So the cattle feeder will gain some leverage, and we should see these prices push a little higher for finished cattle, even if packers can't push box beef prices higher. We're still at record levels. I mean, I've been talking about that 250 mark for a long time, and it sure seems like a support point, going all the way back to April of last year, and we've yet to fall under it. I'm not going to say we won't fall under 250 on box beef, but it sure has been a support point for the past year and 15-16 months. Here's that drought monitor. Unfortunately, you can see Texas, Oklahoma, Kansas, Nebraska, South Dakota, and everything west of there. Some places in some severe drought. We've got some droughty places in Tennessee, like we were talking about at the very beginning of before we got started this morning. With all this severe heat that we're having here, it won't take but a few days, and we'll start experiencing some drought issues. 2 weeks ago, we were experiencing drought issues in many parts of Tennessee, and just a few more days of this heat, this high 90s, and we're all going to see crops start to wither, and grass start to wither as well, and probably all be praying for rain. Might ought to start today if you hadn't already, because we're going to need it pretty quick, and it doesn't look like there's any in the forecast in the at least the next 7 or 8 days. So might be something to start thinking about. We always have to have contingency plans, but at this particular moment, things look fair, and there's little concern. But within, like I said, within 7 or 8 days, we may all have different thoughts on that. Corn prices remain elevated. This is making cost to gain very, very expensive. It's going to be tough. I mean, the feedlot has 2 things to purchase. That's feeder cattle and feed, and they've got one output in finished cattle. And so if corn prices go up, what does that mean for feeder cattle prices? Well, typically it used to mean that feeder cattle prices went down. That's not necessarily what we've been seeing, but just expect that these prices remain elevated. It will keep feeder cattle prices tempered to some degree. Here's what it's been costing to finish cattle in the feedlot in Kansas. For animals that come off feed in April was $1.20. May and June will definitely be higher than that, because we've had continued higher feed prices. We've got a lot of places that if you placed them on feed right now, you're looking at 140 or higher in some cases on total cost to gain. So it's expensive to feed cattle. There's not a whole lot of margin there, and that's one reason why we haven't seen these feeder cattle prices just really take off, because terribly expensive to feed them. We're not getting paid on the back end. And frankly, who wants to enter into a situation where they know they're going to lose money? It's tough. We'll see how that plays out. Here's what the August futures market has done over the past, well, since the beginning of the year, really. Peaked back there in February, and we had a little run up last week in prices, the last 2 weeks, to come off our lows, and then they were soft again Monday and Tuesday. There's just tremendous volatility in this market, and it makes it difficult to hedge cattle using options, because options become very expensive in such a market. It also makes it tough to use a straight hedge, because a straight hedge, as Aaron mentioned earlier, there's those margin requirements, and having enough cash on hand or liquidity is very key to being able to hold a hedge position, a straight hedge position. So, all tough situations. Well, I can't see what month that is because the little streamer is over the top of it, but I think it's either October or November, I believe. But it's October. I see the symbol now. And so similar thing, October, very, very similar pattern, slightly higher prices than August. But looking out when we might sell cattle, there are things to be thinking about there. I've got a few price projections. There's some finished cattle. I do expect things to be pretty fair most of the year. I don't think there's going to be a whole lot of up and down moving forward, and I do have high expectations going into 2023. Feeder cattle price forecast fairly strong, but I really think that if you'd asked me 6 months ago, these prices would have been higher. You can kind of pick where you are there and look at that. But what I want to talk about real quick is LRP. And the reason why I want to talk about LRP is I've realized over the past 6 to 8 months that with the changes that have been made to LRP, there are some really good opportunities, especially given the environment that we're in right now. And, it's a way of setting a price floor. It acts very much, this insurance is just like a put option in that you can set a price floor just by paying a premium. And, you just got to, the key is finding somebody that you can call and say, hey, I want to buy this stuff. And we've got several people across the state that are selling LRP, and you just have to be ready, and you have to be active in your marketing. It's one thing that we as cattle producers tend to be put a little focus on is our marketing efforts. We can sell them every day, but we do little in marketing. But the thing is what it comes down to, they may have coverage levels that range from 70 to 100% of the expected price. The way this works is the LRP uses the futures market and the put options market to set cost and price levels for certain time periods. And in doing that, what we've determined that if you're not buying probably 98 to 100% coverage level, you're wasting your money anyway. So that's the same thing that the same reason why when we're buying a put option, a lot of times we buy something that's at the money or really close to at the money, because if you don't, you're probably wasting your money. So some things that we've been seeing is that we have started to see an increase in use of LRP. And the reason I think that we're seeing this, that they've made some changes, and now a person can cover up to 24,000 head on an annual basis. Well, so what that does is that means some of these big producers have said, hey, this might be something I can use, and I think they are using it. And I'll give you an example. If you look at June, marketing cattle in June and July, the August feeder cattle market is the nearby feeder cattle contract. And our basis was something like $17 or $18 based off the lower Middle Tennessee sale that was back at the 1st of June. And that was way out of line with our typical basis. Well, the one benefit, or maybe I should just say one benefit of LRP is that as soon as you set your floor price by purchasing LRP, what the futures market does means nothing anymore. So what the basis actually, whatever basis actually occurs with the futures market means nothing, because it's indemnified based off that CME feeder cattle index. And I know some producers that greatly benefited from that in the past year or so, where if they would have hedged on the futures market, they might would have got paid a measly $5-6 a hundredweight. Well, because they were hedged with LRP, the basis did not matter. All that mattered was what that CME feeder cattle index price was, and they end up gaining, $12-13 a hundredweight. And $12 and $13 a hundred. I mean, $5 and $6 is nothing to shake a stick at, but because they got rid of a lot of that basis risk, because we have so much volatility in the market and so much uncertainty, it has benefited us from that standpoint. And I think what we're seeing a lot of people do now is they're setting their floor with LRP, and then they may be offsetting some of that by selling calls or something, and essentially creating a fence. But they're benefiting from this floor price on the LRP. There's a higher subsidy rate. It's fairly inexpensive. It's cheaper than a put option. And this is what was offered yesterday afternoon for September. Some of the things offered for September. Hopefully you can see that. The cost, if you look there for a September 13th sale, you could cover a 171.57, that very top line. You could have had a coverage price of 171.57 for $4 a hundredweight. So for an 8-weight steer, that's $32 a head, and you could have guaranteed yourself a very, very strong value at 171. I think this is a lucrative thing to be considering, especially given the volatility that we're having in the markets. If there's a price that you can capture that gives you a profit, there might be very, very good reason to do so. Like I said, you could get down here in some of these lower valued coverage levels, but even a 91% coverage level, which is the one at the very bottom, it would only cost you 86 cents a hundred, so less than $8 on an 8-weight. But do you really expect prices to decline $14 between now and September? And if they do decline that much, wouldn't you just as soon had the 171 for $4, which was $32 a head? You can think of it whichever way you want, but that's kind of where we are. So